It's a pleasure to be here in these weird times. I've been told that this room, this space here looks very different in normal times with much more people around. Unfortunately, we have to operate this year in these circumstances of the pandemics. But nonetheless, I think that the program at least what I saw, the program looks very good and that you will enjoy the conference. It's my pleasure also to be invited here and to talk today about the regulation of the financial industry in the context of the Fintech. From what we see here, it's all about modern things today or things that wait for us in the future. And I come from this building. This is where I work, where I spend most of my days. And that one doesn't look very modern, as you can see. It's basically patterned on a design of a Greek temple, which is the role model for these Ionian columns, and that backs to the ancient times. So you probably wonder what this relics of the past has to do with the conference about the financial innovations, future of money, future of the Fintech. But from our standpoint, it does. In what sense? Because once you strip the technology and other fancy user features, what is left underneath also matters. And what matters in mind of the central bankers, people like myself, is stability. Money is all about the stability. Our main institutional goal as the regulators of the financial system is stability of your money. This is what these columns that you can see symbolize, and they are not just standing there to impress the visitors or the photographers, but to remind us that work in that building of our duties of keeping the stability. Let's now move to the Fintech developments, and later we'll put them in the context of stability. Today, one of the key challenges for banks as traditional financial institutions is the need to respond to increased digitalization and the growing competition of the Fintech providers. Digitalization is at the same time a threat and opportunity. It represents a threat because it challenges the way banking has been conducted for centuries, but it can also be considered as an opportunity in the sense that the modern technology enables banks to be more cost efficient as more and more services are being provided online or via mobile phones rather than through bank branches. Yet the emergence of fintech companies still has not seriously undermined the position of the banks. Not that long ago, at the beginning of the century, I remember visiting conferences where many people were predicting that telecoms will take over banking industry because they have larger balance sheets, they have better ways of communicating with the customers, and people were predicting that they will just buy out the banks and take over the business from the banks. Today, it's clear that this has not happened. It's also clear that some other predictions, like that the large IT companies will take over banking business, have not materialized. People are also predicting that companies like Microsoft might take over the banking using their unique channels of approaching the customers and taking over the banking business. But today we see that has not happened either. And maybe it's better that they didn't do it because they're now in the business where the return on equity is much higher than the return on equity in the banking business. What banks have learned in the meantime is that they need to be very responsive to the new trends if they want to preserve their dominance in the financial services business. They understand they have not been challenged in terms of their business being taken over by the fintechs, telecoms in the old times, large IT giants or fintechs today, but they understand that part of their businesses have been dented and that they have to adjust to the new competitive environment. What we see is that for the time being, fintech firms have not challenged banks in two major areas: deposit taking and lending. There are fintech innovations in both areas, but not a serious threat to what the banks are doing. But they did it in a third area, and this is the payments. Payment system challengers are offering new and less costly ways to execute non-cash transactions. On top of that, they have even offered a new architecture, new payment systems with their own money hovering somewhere in the cloud out of the control of regulators, central banks. An additional major challenge which emerged last year in 2019 was Facebook's announcement of its plans to enter the global financial system by providing a digital currency called Libra. Libra was supposed to allow billions of users to make financial transactions across the globe. That was a serious wake-up call from the regulatory standpoint. Before that, I wouldn't say that the regulators would that much attend to what's going on in the field of the cryptocurrencies. If it had materialized, namely, the emergence of such global payment initiative would have been an event which would challenge the traditional financial architecture which we have today, affecting both the commercial bank's business as well as the role of the supervisors in regulating the financial markets. In a way, there were just too many risks involved in that. Having a supranational, privately owned, quasi-central bank, in a way. So the regulators' response, as you have seen, was swift. Now, having said that, let me now turn to the money, and then I'll come back to the stablecoins later, because this conference is about the money shifters. Let me try to briefly explain how we define money, which functions money serves, and how we gauge whether the money is sound. Money, as you know, is at the heart of all economic transactions. It flows between households, businesses, and other stakeholders. It is the vital component in the transfer of goods and services, and therefore it's crucial for supporting day-to-day economic activity. But not only that. The importance of money is in its ability to stretch purchasing power over time and to allow for spending decisions to be postponed. If not spent immediately, money also helps to facilitate investment and contribute to economic growth. There is already a universally accepted view that money is a public good. This is useful to recall whenever one embarks on a journey of constructing a new, more modern or fancier form of money. Because whenever one wishes to innovate in the field of finance, there is also a possibility of things going wrong and leaving, therefore, serious consequences with broader impact than on a single company or a few companies, broader social impact. Money has historically served three functions. This is a unit of account, a store of value, and a medium of exchange. To fulfill its unit of account function, money is defined by law as the only currency accepted within a given jurisdiction. It is the legal tender on a certain territory. It supplies under the control of the central bank, and the transactions are denominated in that currency. Other two functions, store of value and medium of exchange, are provided to households and businesses via banks in the current architecture of a banking intermediated monetary system. In the past, we had different experiences, but they have not served the society equally well as the current architecture. What makes money sound? There, the answer is quite straightforward. Money is sound if it performs these three functions properly. But money has transformed over time. It is transformed from cattle and shells thousands of years ago to today's modern paper and digital money. There is a very well-documented case, for example, how cigarettes served as money among prisoners in World War II, and again later in the US prisons. After the US government banned cigarettes, these were replaced with postal stamps. Just recently, I have read a study, and there is even a book on this, how ramen noodles are now used as favorite form of money among the inmates in prisons. I'm not quite convinced that ramen noodles' value stays the same over time, but neither was true with the cigarettes. However, in a high-frequency trading environment like prisons are, there is probably enough merit in noodles to serve as money. These are, of course, only anecdotal cases to prove the point. Money today is technologically advanced. It's stored as a digital entry. It's an electronic record, a global footprint of a modern age. The total value of digital money, such as bank deposits, today is many times larger than the value of its physical counterpart or cash. And to further clarify where we are, let me say a few words about the monetary architecture. The monetary architecture stayed same now for a very long time. It looks as follows. Central banks issue cash and reserves, while banks issue deposit money. Central banks control money supply. We do that via banks, which are, in return for performing risk and maturity transformation, allowed to hold accounts with the central banks. And it is through these reserve accounts in the central bank that the monetary policy is pursued. And all transactions are eventually settled through these reserve accounts. It's a closed-loop system under direct control, management, and supervision of central banks. In a way, this is also quite different than, let's say, less than a century ago, when most of the money was in a physical form, both cash and paper records of reserves. While today, it's mostly computers doing the job of keeping the data records. So with by far the largest chunk of central bank money today being already digital, it's very sophisticated and automated computers that maintain the system. The system, which is fast, scalable, secure, and equipped with the latest technology. However, we are closely monitoring what is happening in the world of money digitalization pursued by the private sector. With all the fintech challengers around, it's important to continuously check whether there was a real shift in the architecture of money, or is there merely a continuation of a technological trend, another novelty? So let us look now briefly again into some of the important private initiatives in this area. First, of course, we'll start with the cryptocurrencies. These were, I would say, the first serious challengers to the monetary architecture I have just briefly described. Cryptocurrencies, such as its most prominent representative, Bitcoin, offered a new architecture. This architecture is alluring, so it even created a movement based on its technology, a blockchain movement. What is unique is that the cryptocurrency architecture has introduced its own unit of account and medium of exchange. It's based on technological novelties of proof of work, decentralization, and blockchain. Nevertheless, 10 or more years later, we are still waiting to see if it fulfills its promise to become a new money. From both payment and financial perspective, I do not see how it could qualify as money. Its value fluctuates erratically, it lacks scalability, it is energy inefficient and relatively slow compared to the payment systems that we have today. Therefore, I do not see how it could efficiently fulfill any of the functions mentioned earlier, and to be very blunt, it's far from money as it could be. In a world of complex banking regulation aimed at protecting people's money, and where stability is of the essence, as I said, we see it merely as a speculative investment. Apart from that, cryptocurrencies also built a dubious reputation as money laundering heavens. Still, again, cryptocurrencies remain an innovative concept. Let me turn now to another area, another change that is relevant to us. Well, actually, it's something that regulators, in a way, enabled, in a way that we framed the field in which new digital payment initiatives could develop. You see here it says PSD2, and I'm referring here to the new challengers, both in terms of new forms of money, like electronic money, and new players, e-money institutions, PISPs and AISPs. It was first in 2009 when the e-money directive was enacted, and then in 2018 when the updated version of another relevant directive took effect. The latter is well known under the PSD2 abbreviation. What we have tried to achieve with these two pieces of legislation is to accommodate both demand and supply side of the payment systems and payment services ecosystem, and to level the playing field for both incumbents and for the challengers. However, this architecture also did not fully live up to the expectations. Its current state of progress is the consequence of a historically low interest rates financial environment, time needed to build stronger network effects, deeply penetrated credit card schemes, still non-existent EU interoperable clearing regimes, and new players not being allowed to directly connect to clearing and settlement payment layers. Even though it failed to some extent, some of its policy enablers, e.g. open banking, surfaced. Open banking is the major source of innovations for challengers, but is at the same time a great tool in promoting competition between incumbents. In Croatia, all banks have implemented open banking standards via application programming interfaces. The challengers, fintechs, payment service providers are now able to make use of bank data on behalf of customers in many innovative and helpful ways. Let me now turn to what I have already mentioned, stablecoins. This is the third major challenger to the current monetary architecture. Stablecoins have emerged in an attempt to overcome the volatility of first-generation cryptocurrencies. Stablecoins have further developed the cryptocurrencies architecture, primarily in an attempt to correct previous major flow, which I already mentioned, as they promise to minimize fluctuation in its value against a reference currency such as the dollar or the euro, or a basket of currencies consisting of several major global currencies, as Libra was promising to do. So in a way, it's a hybrid architecture, having characteristics of both cryptocurrencies and e-money at the same time. However, as I have already mentioned, it was only after the announcement of Libra that the global stablecoins initiative got the full attention of the central bankers and the regulators overall. If Libra were to be launched, 1/3 of the global population could become its users very quickly by making only few clicks on their mobile phones. Even though today, after the swift response by the regulators, Libra project seems to have been abandoned, under that name, recently it has been rebranded into Diem. So the idea is very much still alive. Global stablecoins offer alternative payment arrangements and challenge both to national monetary systems and the current cross-border banking remittances market, worth approximately $700 billion yearly. Idea of global stablecoins offers an idea of operating in one jurisdiction, denominating in another currencies, and being used by customers in a third jurisdiction. This raises questions about the impact on monetary policy and financial stability, on the banking system, on money laundering controls, on consumer protection, etc. Global stablecoins ascent could mark the point at which private companies outside the scope of the regulated financial system become major players in the international financial architecture, diminishing the role of central banks and current long-time developed regulation of the financial system. So the stakes are really high here. And in my opinion, and the opinion of other governors and financial market regulators, stability could be at stake. Therefore, as old saying goes, when the road is slippery, you take small steps. Which brings me to another topic, which is the newest one, I would say, but has drew a lot of attention lately. That's the central bank digital currency. This is the central bank's own challenge to the existing architecture, and a recent survey found that 80% of central banks are engaged in investigating central bank digital currency, and half have progressed past conceptual research into experimenting and running pilots. But what is the central bank digital currency, and what are the reasons for such a move by central banks? The CBD is the central bank's liability offered in the digital form for use by citizens and businesses for their retail payments. In essence, it's a central bank's digital equivalent to cash. If it materializes, CBDC will represent a true shift in the monetary and payments architecture. The main triggers for central banks' widespread interest in CBDC are both national and international. On the national level, central banks are responsible for the safe and efficient functioning of the payment system. So far, cash has served the purpose of a backup option in case the digital payment infrastructure fails. But with the declining use of cash, or even in the case of its near total abandonment in some countries, it is up to the central bank to provide alternative solution, since money is, as we previously said, a public good. The other trigger is international. Current cross-border transfers, as many fintechs themselves have properly understood, are costly and cumbersome. Besides, many central banks want to offer scalable, fast, secure, and even globally reachable digital currency. Countries first to implement such a solution would have the first mover advantage and could create a strong network effect, or could even, at least partially, challenge the dominance of the well-established reserve currencies. 2 months ago, the European Central Bank published the report on a digital euro. This document paves the way for the potential euro-based CBDC issuance. What is important to note here is that this new form of money is meant to complement the existing two, reserves and the cash, to exist alongside them and not to replace them. But creation of such a CBDC is much easier said than done. There are many open questions left with the particular design of the central bank digital currencies. Whether the CBDC is tiered or not, whether it's remunerated or not, whether it's account-based or it's token-based, whether it's anonymous or not. If anonymous, would it be full anonymity or only to some degree? What about the cross-border use of the central bank digital currencies? These are all open questions at the moment that are discussed in the central banking circles. But we still don't have answers. And answers to these and other questions are crucial for the design of the CBDC and its implementation. The implications CBDC could have both on monetary and financial stability and the role of central bank are particularly important. To what extent CBDC could disintermediate the banking sector, and what could be the impact on banks' funding costs? How to mitigate the risk of a bank run once we have a CBDC? Which services and infrastructure along several steps of payments value chain should be central bank, and what might be left to the private sector? Whatever option is chosen, safe, innovative, and integrated payments is the ultimate goal. It's also the Croatian National Bank goal on our path to the euro introduction. Having said that, let me just remind you that our national payment infrastructure is fully compatible with that of the euro system, and that just recently we have introduced an instant payment system in Croatia. It enables transferring money instantly, either through existing channels or through mobile applications, just by knowing the recipient's phone number. Croatia's instant scheme is based on SEPA credit transfer instant payment scheme and stands ready to pan-European interoperability once we adopt the euro. Which brings me to the last part of my speech, and this is the outlook for the fintechs. So just a few thoughts before I finish. Where do we stand today? The world has obviously changed a lot. Mobile phones are ubiquitous. Instant messaging and social networks are a key part of many people's lives. Digital connectivity has changed not only our leisure time, but also the way we do finance. Sending money is as easy as sending a message today. In essence, this is what money transfers really are, at least from consumer perspective. Sending nice and user-friendly messages. Nevertheless, while digital challengers are trying to increase efficiency in delivering financial services, widen their range, increase competition, and promote financial inclusion, they are bringing challenges as well, posing new or old risks in the new models to consumers, investors, and more broadly to financial stability and integrity. When designing an adequate policy framework, regulators need to find a balance that maximizes benefits of innovation, while at the same time minimizing potential risks to the financial system. To achieve this, it is always useful to stick to the golden rule of supervision, Same business, same risks, same rules. This is what we do when confronted with various tech buzzwords and the vivid clothes of technological progress. We try to discern between the relevant and irrelevant. We try to strike the right balance between many options, to find an approach which is risk-based and proportionate. And what is very important for us, the one that, again, provides stability. And now just one more thing to conclude with. Let me use this opportunity to invite all of you interested to contact the Croatian National Bank's Fintech Innovation Hub and share with us your innovative ideas in the area of banking and payments. Many of you have already done that. Money Shift conference participants, or money shifters if you want, we're inviting you to throw any ideas you might have at us, and together we will check how those ideas fit to the current architecture and how fit we are together for the digital age. We can count on you, I hope, as much as you can count on us, on our assistance. Our goal is to assist you in developing the products in the phase of innovation, so you don't spend time to develop something that, in our view, will not be consistent with the financial architecture and the stability concept that I already mentioned. So having said that, if I can picture a central bank of digital age, my office, then it could maybe look something like this. But it will still represent stability, which means that digital Ionian columns will be as solid as the ones that you can see today, ones that have represented stability since the ancient times. So thank you very much, and I wish you a very successful conference.